Australia's monthly inflation print lands in less than 24 hours, and the trap is already set. Right now, while retail traders are licking their lips chasing a pre-CPI breakout, the institutional footprints are telling a completely different story. Price is pinned exactly where the sellers want it, coiling under a resistance zone that has rejected every single rally attempt for weeks. There is one specific danger zone today that will wreck late longs, and one hidden opportunity that aligns with the monthly strong sell pressure. I'm going to walk you through both, and if you stay with me until the strategy section, I will give you 3 precise trade setups with exact entry coordinates, exact stops, and clear risk-reward ratios that you can apply immediately. Do not navigate away from this page. Here is your instant market verdict. Australian dollar to US dollar is currently trading at 0.7161, and my session bias is unequivocally a fade. I am looking to fade any spike into the overhead resistance block between 0.7186 and 0.7204. The monthly chart is a strong sell, the weekly chart is a strong sell, and the daily chart is trapped in a neutral compression that is about to resolve violently. The one invalidation level that proves me completely wrong and forces a structural flip to a bullish breakout chase is 0.7204. Write this number down, carve it into your trading desk, tattoo it on your brain. If we get a clean 4-hour candle close above 0.7204 today, the entire bearish narrative disintegrates and we stop fading and start buying pullbacks. Until that moment, every single pip higher is a gift to short sellers. Type that number in the comments right now, 0.7204. Let's see how many of you are actually paying attention to the level that changes everything. Now let us drill into the multi-timeframe technical deep dive because the moving averages are telling a story that most traders are completely ignoring. On the weekly chart, the trend remains aggressively bearish, and price has been grinding along a descending value path with the 200-week moving average far above. That long-term gravity is acting like a silent anchor, dragging the pair lower even when the daily chart looks neutral. Dropping down to the daily timeframe, the battle is happening right at the 20-day moving average. The daily MA20 is sitting at 0.7164, practically identical to the daily MA10 at 0.7164. Price at 0.7161 is pinned 1 pip below these averages. This is not a coincidence. This is an institutional magnet. The daily MA50 down at 0.7121 is the dynamic support floor that has held price multiple times, and that level aligns almost perfectly with your horizontal key support at 0.7124. The daily MACD is showing a reading of 0.001, effectively dead flat on the zero line with a histogram that has zero conviction. That is not a buy signal, that is a coiled spring of momentum exhaustion. RSI on the daily sits at 50.24, absolutely center, giving no directional bias and confirming that we are in a pre-explosion compression phase. The daily MA100 is far below at 0.7023, and the daily MA200 is way down at 0.6863. Those levels are acting like a gravity magnet, and if the support at 0.7124 breaks, the momentum will accelerate directly into that 0.7023 zone. Now let's step down to the 4-hour chart for execution timing. On 4-hour, the moving average ribbon is beginning to roll over. The 20-period average is curling down toward the 60-period, forming a near-term bearish death cross that aligns with the lower highs we have been printing since the last rejection at 0.7200. Price is struggling to hold above the short-term structure support, and every bounce is being sold into. On the 60-minute chart, the trend is a clear sell with price stuck below the Ichimoku cloud, building a flag pattern that is mathematically ready to break. The critical intraday support sits at 0.7146. That is the line in the sand for the session. Below that, the trapdoor opens straight into the daily MA50 at 0.7124 and then the psychological magnet at 0.7100. The resistance is layered. 0.7186 is the first brick wall where the last rally died, and 0.7204 is the structural ceiling. Here is what most traders miss. Because the daily RSI is exactly at 50 and the MACD is flat, the market is providing zero confirmation right now. The breakout traders will get chopped to pieces, and the only edge lies in fading the extremes at the edges of the range until the inflation number forces true expansion. This is a range fade environment dominated by a larger bearish trend, and that is a professional's playground. The next signal changes everything, and it ties directly into fundamentals and cross-asset linkage. Never forget what the Australian dollar truly is. The Aussie is the China proxy, the risk barometer, the currency that absorbs every tremor in the global reflation trade. Over the last 24 hours, the core narrative has been the looming Australian monthly CPI indicator. The market is bracing for the data, and positioning is extremely tight because this number will directly shape the Reserve Bank of Australia's rate path. If inflation comes in cooler than expected, the already fragile hiking expectations will evaporate, and the carry trade unwind will hammer the Aussie lower. If it comes in hot, we could see a spike toward that 0.7204 invalidation level, but I will show you why the monthly strong sell structure likely absorbs that spike and reverses it. Here is the cross-asset web. The US dollar index is holding firm, refusing to break down, and that is suffocating any sustained Aussie rally. At the same time, iron ore futures are sending mixed signals, reflecting uncertainty around Chinese stimulus effectiveness. The Nike 225 and S&P 500 risk sentiment has been choppy, and the Aussie historically cannot sustain a breakout when global equities are struggling with gamma resistance. The Chinese economic data pulse remains weak, and that is the silent killer for Australian dollar to US dollar longs. My 1 to 2 week directional lean is for a breakdown below 0.7124 toward the 0.7075 and eventually the 0.7023 daily MA100 magnet. The exact event that invalidates this medium-term bearish lean is a clean weekly close above 0.7204 combined with a blowout Australian inflation print that forces RBA rate hike pricing back to the table. Without that, every rally is a distribution opportunity for the big players. Most people will click away right now, but this strategy section is where the money is actually made. Keep watching because I am about to hand you the exact coordinates. Here are your 3 strategies for Australian dollar to US dollar today. Strategy 1, the sniper, the conservative approach for those who want confirmation and refuse to guess the news. You will do absolutely nothing until the Australian CPI data is released and the 15-minute candle closes. The trigger condition is a clean 15-minute close below the critical session support at 0.7146. That confirms the trap has sprung and the monthly sell pressure is taking over. Your entry is a sell stop at 0.7144, just below the level to avoid slippage noise. Your stop loss goes at 0.7186, sitting above the intraday resistance and the false breakout high, giving you 42 pips of structural invalidation room. Your first target is 0.7124, which aligns with the daily MA50 and the key horizontal support, netting you 20 pips. Your second target extends to 0.7075, just above the psychological 0.7070 level, offering a risk-to-reward ratio of roughly 1 to 2.5. If the move accelerates, you can trail your stop to break-even once 0.7124 is hit and ride the momentum into the daily MA100 area. This setup is completely voided if price spikes above 0.7204 on the news release and holds. Do not chase, except that the structure flipped and stand aside. Strategy 2 is the active trader, a standard pre-news fade for those who understand that resistance is a zone and not a line. We know the resistance block sits between 0.7186 and 0.7204, and with the session bias to fade, you place a limit sell order at 0.7180, letting the intraday noise push price into your fill. Your stop loss is placed at 0.7210. Just above the absolute structural invalidation level, providing 30 pips of protection. The logic here is that if 0.7204 breaks, you do not want to be short, and this stop gives a technical buffer. Target 1 is 0.7146, the session support, giving you 34 pips. Target 2 is 0.7124, the daily MA50 convergence, giving you 56 pips. The moment target 1 is hit, immediately move your stop loss to break even. You are now in a risk-free trade and you let the daily downtrend do the heavy lifting. Here is the retention bridge. Let's see how aligned our community is. Pause for a second and type your forecast for tomorrow's Australian dollar to US dollar high-low range in the comments. Give me a number. I am actually reading them, and I want to see who has been paying attention to the compression and who is still gambling blindly. Strategy 3 is the aggressor, strictly for those who know how to lose small and scalp momentum without emotional attachment. This is a high-risk, counter-retail entry on a 60-minute breakdown. If price breaks below 0.7146 intraday before the news, and we get a 15-minute candle close beneath it with expanding volume, you can enter a momentum short at market, targeting a fast scalp. Entry around 0.7144 with an extremely tight stop at 0.7162, above the 60-minute volume-weighted average price resistance. Your target is 0.7125, a quick 18 to 20 pip scalp, with a final chunk off at 0.7100. The risk is that you are fading against daily neutrality, and you could get whipsawed viciously if the break is false. Explicit warning. This is only for traders who have absolute discipline. If price reclaims 0.7162, you are out instantly, no questions. Do not let a small loss turn into a blown account. Never risk more than 1% on this aggressive play. 1 sentence for your risk management pulse. Never risk more than 1 to 2% of your capital on any single trade. Do not carry open positions through the high-impact Australian CPI release unless you are fully hedged, and hard stops are absolutely non-negotiable, period. Now let me synthesize everything into the single most critical level for your next session and close with a retention loop that will keep you ahead of the market. The one level that matters more than any other tomorrow is 0.7146. As long as price holds below 0.7204, and especially if it starts to break down through 0.7146, the entire monthly and weekly strong sell pressure validates and the move toward 0.7023 becomes not just possible but probable. Tomorrow's focus is the Australian CPI aftermath, the volatility funnel right after the data drop, and the potential for a structural breakdown if inflation undershoots. Do not trade the first 5 minutes of the news. Trade the reaction after the trap is set. The Australian dollar is functioning exactly as the China proxy risk barometer right now, and when the liquidity tide turns, the Aussie will lead the charge lower. If you want the full breakdown on Bitcoin and the shocking S&P 500 divergence that is developing right now, that video is live and waiting for you. Tap the end screen right now. Smash the like button if this analysis gave you a clear, actionable plan for Australian dollar to US dollar. Subscribe and ring the bell for daily institutional coverage of 8 key assets. I map the traps, I give you the levels, and I never waste your time. I will see you in the next one.